Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm Lance, host of Real Estate Risk Report. Today I have with me Dylan Marma with Requity. How are you doing today, Dylan?
I'm doing great, Lance. Thanks for having me.
Yeah, my pleasure, man. So why don't you give us a little bit of, background? I know that you've been really digging in a lot into sort of the mobile home park stuff, which I think is, been kind of a really intriguing asset class, especially as we head into a recession. I think that this particular asset type has, been pretty resilient. And I think a lot of people are interested in learning more about it. So we'll kind of focus today on that particular asset class. I know that you obviously have sort of been in the commercial real estate business for a long time and, have your CCIM designation and those things. But why don't you just give a little bit of background and kind of how you ended up, with forming Requity and all those things?
Yeah, so it actually all started off for me in the apartment world. About 4 years back, I got big into multifamily, and most of the deals I've done have been sort of multifamily syndications that I've sponsored and worked with over 100 active investors on a deal-by-deal basis, buying value-add apartments, B and C class apartments. And I really was a firm believer, and still am, in the sort of the workforce apartment space and being able to serve those that are underserved currently, and start to play a part in solving sort of the affordability crisis by making safe, clean, affordable apartments for folks to live in. As I think there's always going to be a lot of demand there, and there's always a lack of quality product available to folks in that niche. Now, as anyone participating in commercial real estate has seen and witnessed, the apartment space has seen a lot of traction and has gotten increasingly competitive over the last few years. So I think it's really a sport more than anything that requires being hyper localized, really knowing your markets extremely well, and being able to out operate the next guy. So while apartments are something that I plan to always have my foot in the door with, and continue to be involved and grow with, I've taken an increasing liking towards the mobile home park space, especially starting off at the beginning of this year. I had a sort of a split up from my former partners, and at that time I really took a look around and said, well, what do I really believe in wholeheartedly that is going to be a quality place to put money in this year. And it was actually, the midst of sort of the whole COVID breakout. So we knew there's a lot of uncertainty out there. And that led me back to mobile home parks. And I linked up with a partner that has a substantial amount of experience. I've done about 50 million or so in apartments at that point. He's done about 50 million or so in mobile home parks. And together, I think we brought unique things to the table in terms of our operational experience, as well as our capacity to raise capital, to find deals, and so on. And we really started to aggressively pursue the space. And we've caught good amount of traction since then with several deals under contract and recent acquisition. So we're definitely excited about the space. We're planning to do a number of deals over the next year or so, and I think there's just a lot of opportunity, and I think there's always risk involved, right? And that's why hopefully we'll cover some of that on today's show.
Yeah, exactly. Yeah, so I think that is the mobile home parks. Just to sort of cover the fundamentals of that particular strategy, right? It's what you typically are sort of looking at, sort of by lots, right? And so effectively, you're sort of the fundamental thing is sort of a land lease, right? So people are paying X amount per month to lease that particular lot, and then you would have the concept of many of them own their own homes that they put on said lot, and then potentially, as part of the acquisition, you buy some of the homes that are then sort of, leased all in. So for for you guys, I mean, just looking at once again, kind of panning out a bit, I mean, what does it separate into? Like, there's people that are kind of like multifamily, where it's sort of like guys that are targeting, 100 lots or less. And then there's guys who are targeting 100 lots or more. And, obviously the locations. And yes, I guess just maybe give us sort of the high level view of how the market sort of, breaks apart, right? Like,
mm-hmm. Yeah. So to start, I'd like to start with sort of what inning are we in, right? And of course, this is always a guessing game, and there's always some speculation to it. But I think we are well beyond the innings of where you're able to buy bargain deals that are just going to be complete layups and easy to operate, right? So no matter what size deals you're looking at now, I think we're at a point in the game where every once in a while you might find that unicorn deal that comes out of the sky and it's just perfectly priced to go and get a great yield. But I think right now we're probably, in the later half of the game to where we see consolidation in front of us. It's evident that there's a lot of big money moving in with Blackstone just having put in, I think, $500 million in the last few months, and some record, breaking sales. I think pricing's up over 20% year over year. So I want to start and just make it clear to everyone that there is competition. This is not just a game where you can go in and buy at a 10 or 12 cap, especially in a good market or a really quality deal. We're seeing consolidation. We're seeing cap rate compression. But our whole thesis right now is that where the real value is in value add type of deals, right? And this has been the name of the game in multifamily for many years now. But in the park space, it's no longer just a game of just buying on a pure in place kind of cash flow. There's new financing options available that will help you with the value add plans. There's a lot of upside if you're doing this stuff right. So where we see the value is in, like, as you mentioned, sometimes a lot of the homes that we're targeting are park owned home heavy parks, right? And of course, the ideal place to be long-term in this space is having tenant-owned homes, because at that point, as you mentioned, you're really operating a ground lease to where you're solely responsible for collecting lot rent or rent on the ground that the home sits. And it's very low maintenance. It's very low CapEx. You run at a nice lean expense ratio. You can run at a nice lean payroll as well. And there's it's the mecca. It seems like one of the ideal investments you could possibly ask for. Mm-hmm. Especially when you compare to multifamily. Here's the big difference. When you have an all tenant owned home property, you might have 98 to 99% retention year over year. They don't leave. They're homeowners. They have skin in the game. They're staying long term. On a multifamily property or a heavy park owned property, you're having 50% turnover. You're constantly having turnover. You're constantly having turn costs. You're having to have the right staff in place to handle that kind of thing. So one of the value add type strategies that we have in place is to actually purchase these park owned home places. And we'd run them just like we'd run an apartment building, being ready to handle the turn costs that will take place. And then over time, we put in a home ownership program to incentivize either some sort of a kind of a rent to own type of a model, or some type of a model where we're able to sell the homes back to the residents. And through converting that, we lower CapEx, we lower OpEx. And eventually we position the property to exit at a nice low cap rate, as it's more of an institutional type deal that will now be qualified for Fannie Mae, Freddie Mac. A lot of the agency lenders need to see at least 35% or less of the park can be park owned. So that's one form. And then we also have the other forms of value add, which are the traditional rent raise, right? If you're finding a below market rent property that's already largely tenant owned, you can of course go in there and raise the rents. We have to be very careful about this because we're not trying to give the industry a stigma, right? You have to be understanding of the fact that it costs people thousands of dollars to move their home. So we want to do that with respect for the residents, of course. So it is that is definitely a longer term, more gradual process oftentimes. And then the last form of value add that comes to mind, and of course there's a lot of different little nuances we can talk about, but the last big one is sort of an expansion play. And the expansion play deals with expansion through either infill. Infill means that the park is already developed and there's an opportunity to bring homes in and sell the homes off or rent the homes out on the already developed lots. This is actually more common than you would think, because there was in the early 2000s, there was a chattel crisis where a lot of homes got taken back by the banks. So you see a lot of parks that have just never been brought back to life or brought back to complete occupancy since then. So if you want to do the work of bringing homes in, that's an option. And the other type of expansion play is development or partial development opportunity, where you can build the lots and bring the homes in. Naturally, you want to be in a market or a sub-market that has high enough lot rents, probably of $400 or higher, to be able to justify doing that from an income perspective. But that's the lineup.
Yeah. So it sounds to me like from your guys' perspective, the strategy that you're looking to execute is sort of, okay, we're going to go in, acquire, a park that might have quite a few park-owned homes, try to put something in place, because ultimately the exit, right? Like if you're saying that, would you say Blackstone or whoever's, BlackRock or whatever is sort of allocating capital into the space, that's more of, I'm assuming, the stabilized product. So in order to have that as a viable exit, which is the sort of value add strategy, you've got to somehow go in there and assess, okay, the quality of these homes that you're acquiring, right? I mean, I'm assuming that that's a big part of it, because if they're not up to snuff, then you're going to have to renovate them. And I mean, that's part of the strategy too, or?
Exactly. Yeah. So that's it's a really good point, right? Because when you're trying to place 500 million, and I don't think people always take that into perspective, placing 500 million into apartment buildings, you can do that in one kind of market. 500 million in parks, there's significantly less total supply. So this space is moving quickly as far as like the whole consolidation movement. There's a limited supply out there. Maybe they say 70,000 or so parks throughout the entire country. So for operators to place that much capital, they have to be buying a lot of different parks. And to handle that, you're hoping that they're less management intensive parks. So for operators like us who are, obviously smaller than those big institutional groups, we have more of the bandwidth to be able to handle the value add projects, because we're not buying nearly as much all at one time. So we can take on the extra work and the extra brain damage that the institutional groups don't want to deal with, and then we can hand it to them on a silver platter at a reduced cap rate or higher multiple once we've established and built a sort of a portfolio around that. And I know you brought up sort of the lot, the size, as in the number of lots. You have the 100 or less and the 100 or more lots. And that's also a big thing to take into consideration. I think the 100 plus lots definitely become more attractive. It seems sometimes it's less important than apartments, because a lot of times the reason you buy 100 plus apartments is because you need to have a full-time community manager and a full-time maintenance guys, and the economics don't support it. But once it's all tenant owned, then you really just need one community manager, and their main job is to collect rents and handle contractors occasionally. But so it isn't quite as important, but it is also just from the sake of, writing a $300,000 check when your job is to place 100 million is a lot of work, right? And even just the idea of having to stop by and manage that is difficult. So I definitely think the larger you go, the lower the cap rate, the better the exit opportunities will be.
Yeah, I mean, and it's just, you look at the space from, it's been sort of the mom and pop, with the exception of the last 10 years or so, right? It's mom and pop owned. And a lot of that I have to assume is just because institutional, I mean, people there, it's all about exit, right? So now that it's kind of like you see in build to rent, a few years ago, institutional investors just weren't into it. They didn't get their minds wrapped around it yet. Therefore so I mean, that made it hard to be the guy who takes homes out of the ground and builds a build to rent community. Like, there's more risk. Well, why? Because your exits aren't as certain. Now they love them, right? And it's the same thing with mobile home parks. Now they love them, right? But then it's also a matter of knowing what it is that they love about it. And so I translate everything that you're saying to say what they love is they want tenant home owned parks. right? That have minimal overhead. Because what I've seen, being in this business and watching, mobile home park operators over the last 10 years, right? It is a different animal from a management perspective. And my hunch is because most of these parks, have had a hard time. I mean, back in the 80s when I grew up, it was cool to live in the mobile home parks where I came from, right? Like that's where the communities were built around them, and same thing. Most of them the homes were owned by the people who lived there. But it seems that when they fell out of favor, more often than not, those people moved out, they got a house, and someone else started renting it. Right. And next thing you know, the mobile home park, the landlord, so to speak, now all of a sudden is deciding to go ahead and buy the house from the people moving out and then renting them out. And now we have what seems to be this is the value add opportunity for guys like you to go in, but you got to roll up your sleeves and you're going to get dirty doing it because to get the other side, it's great. But to get from there to wherever, the vast majority of them are tenant owned. Once again, you talked about financing. So you're going to have to get to, you said, 65% of them or more. So when you're doing that, is the repositioning, because what I've seen some of these guys run into, right, is they go and buy a park that they think they can bump rents on. And then they piss off all of those existing, the tenant, the ones who own their homes, they piss them off, and then they decide they're going to leave. And now all of a sudden it just starts working against you. Like now everyone's bolting, and now everyone's selling their mobile homes to other people or whatever the case may be. And you're sort of in this, it's not a good place to be. So, how do you sort of look at, how do you mitigate that risk?
No, that's a great point. And it's a risk that we're all up against. And I think collectively, the best thing we can do as owners is to take as much of a resident first lens and take an ethical, approach towards increasing the income, because obviously we're incentivized by our investors and building a track record to go out there and increase the rents. But from a macro perspective, if everyone goes in and you have $100 plus rent increases day one, that's going to sound off some alarms. And there's already been many operators that have ended up in the newspaper, because of doing so, right? Because it makes for a nice news story. And the fact is that for many people, $100 a month, if you're paying $250, that's over a 30% increase out the gates, which is really substantial. And a lot of people in this position that are living in the parks are already they're already budgeting and spending paycheck to paycheck. So that to try to budget another $100 a month is very difficult for them. So I think for us as collective group of operators, having some sort of internal protocols as far as the maximum amount that you're willing to, or you're going to increase rents year one, I think is going to be helpful, because sure, in the short term, it might make your returns a little bit less attractive, but in the long term, it can help keep away rent control and can help keep good sort of PR image for your company, and frankly, you're doing the right thing for the people that live in the park as well, right? So I'm not saying obviously we can't increase rents. Oftentimes we have to, but I think that there's sort of a limit. And there's sort of a line that you should draw as far as how quickly you go about doing so, because it's not like apartments, or even on the park-owned homes, they're not keeping the home. They don't have the cost of moving the home, or in the apartments, it's more of like a free market where, hey, if you don't want to pay the rent in this apartment, you have a plethora of other apartments you can go choose from, and then you can find the market rate. Whereas with the homes, they've usually paid off this home, and they have a home that's worth $10,000-$20,000, and they obviously want to hang on to that, and it's going to cost a lot of money to go and move the home. So it's not the same thing, and you can't treat it the same.
Yeah. So when, let's say that you buy a park that has 100 lots, and let's just say that 50% of them are park owned. Going in, will you actually sort of do like seller financing as well? Is that kind of part of the thing where you'll basically convert that asset into where you basically give them sort of the title to the and then in exchange, obviously you've got a note payable on your balance sheet. Is that kind of how it works?
Yeah, exactly. And this is really something you have to work through with kind of on a state by state level to figure out what's going to be compliant as far as the way you go about converting through sort of a rent to own type of a system. But the way that we're currently evaluating right now as far as converting the park owned homes to the resident owned homes is going to be some format of a rental credit type program where the residents will put down sort of an initial down payment amount, and then they'll have a portion of their rent go towards rental credit, which will help them later with the purchasing of the home itself. But again, it's something that you really want to work through with an attorney to figure out, what's compliant on a state by state level. But that sort of thing is the idea. Obviously, we're also encouraging them to go to 21st Mortgage or some of the other banks out there that will finance on a consumer level. But of course, that's not always an option for everyone. So we still try to find some workarounds to be able to provide them with a way of purchasing the home over time via installments or rent credits or something along those lines.
Yeah. And then for you guys, like what sort of areas, what regions of the country, do you have sort of a geographic focus that you're? Yeah.
So we're primarily targeting the Southeast for all of the pretty apparent reasons at this point, right? There's just a lot of growth, and it's usually a pretty landlord friendly market and environment to operate in. We like to target larger MSAs of at least 100,000 plus on a metro level, just because that's usually going to give us a decent employment base. We want to find stable employers. It's not quite as much of a high growth target that we have, but it's more of a stability focused target that we have of just knowing we have a diverse mix of employers, hopefully a lot of blue collar jobs, just something that we can really rely on. We're not looking at really student housing or anything on those lines. We will look at some senior communities. We do still think there's a lot of opportunity in the senior communities. And the last thing that I'd mention is that it's always really important if you're a passive or active investor in these, just to make sure you're also paying attention to what your alternative is to owning a home. So the median home cost, we want to see at least 120,000 median home price in that submarket. That way, when they're evaluating buying one of these homes for 20,000, newer home might be up to 50,000, depending. There's a big enough gap to where they're heavily incentivized to look at purchasing a manufactured home.
Yeah, because I've seen that too, where that's sort of they bump into that where they go between lot rent and then, in this case, the purchasing the home, whether it's seller financed or whether it's, they're obviously bought it new and they're paying for it. I mean, once you start to bump up, what you could just move into a house for, I mean, that's kind of your ceiling, and that's where you get a lot of, and especially too, I mean, you tell me, but I mean, ultimately a lot of these, for many of these tenants, I mean, the reason why and they like the mobile home park is that it sort of gives them their own little space, right? And they kind of have, whereas an apartment, you've got to share a wall with people or, things like that. And so that's one of the benefits for it. But from the mobile home park operator standpoint, you're more concerned about, keeping the grounds up and, you know what I mean? And so you've got those things. So it ends up being the borderline sort of homeowners association. And that also seems like that can create friction for the residents, right? Is sort of, they had, Sally and Jim used to be, it was their park and they were pretty, fast and loose, not to mention the lot rent was below market and, they loved it. Right. And so they kind of had, some crazy stuff out in the yard that they think is art and whatever it might be. Right. Carport that's in disrepair, whatever it is. And then, the new sheriff in town shows up from, out of town and starts to, levy up, warnings and notices and those sorts of things and sort of pisses them off. So, how do you, I mean, once again, it goes back to all this human psychology, but like, how do you how do you deal with that? Because that's how they're going to put their guard up no matter what. There's a new owner.
Yeah, that's true. And you definitely face some of that resistance almost inevitably when you go and take over a property, even though word takeover sounds bad, right? But that's how they perceive it, right? But when you go and you have the transfer of ownership, and as you're moving onto the property, the residents, they have their guard up, and they are just thinking, oh, how much is my rent going to go to, and what's going to go wrong with this owner, right? And it's especially difficult when you have a good owner previously, right? Because they already think that things have been good. They haven't had a rental increase in 10 years and so on, right? So the first thing that we always really encourage is to really reinvest back into the property first. You want to build trust with the residents and show them that you care about them. So a big thing for us is we like to get new signage in. We'd like to improve the lighting more often than not. We also like to power wash all of the homes throughout the park, and make sure that we're fixing up the landscaping, adding in any kind of like seasonal decorations, whatever we can do to just create kind of a warm environment that it feels like a community, feels like home right up the gates. And same thing goes for any amenity projects. If we can do, I don't know, we've looking at dog parks, soccer fields for the kids, playgrounds, things like that, right? That sort of thing goes a really long way. And I think you want to start there, not start with, taking from them before you want to definitely give to them and make sure that when you raise the rents, they're investing in, into the value that you've already added to the park. And then to your point of all the stuff in the yards, that's a big thing, right? A lot of people, like you said, they do live in these homes because they want a home. They don't want an apartment where they're sharing walls. There are a lot of families, a lot of kids running around, and there's a lot of stuff in the yards because of that. So I think you just want to think about how can you actually can find opportunity in the places that have all kinds of stuff in the yards. Two things that I've seen and that we're evaluating on a couple of properties is the storage sheds. So you can actually add a shed as long as you can get approved with planning and zoning and charge a little bit of extra rent each month, right? So you might be able to invest $2,000 in a really nice looking shed that sits outside of each home, and then charge another $50 a month for shed rent, right? Or $40, whatever it might be, 40, 20, even at 25, you can probably make it very worthwhile for yourself. So you now have shed rent in addition to home rent, and that could be an option, something that the residents might like and prefer, especially if they're maybe doing their own lawn and they keep a lawnmower in there, something like that. And then you also have, we have a property right now that we're going to be installing a fence to basically have a boat rent. So we're going to put a big fence in the back corner, and we're going to have boats and potentially RVs get stored in here, and we'll have a boat RV storage in the back corner of the park. So that kind of, number one, creates an income stream for us, and two, it gives them a place where they can park their boats at will, and hopefully it attracts new people and that have boats that don't have a place to keep it. Yeah.
So like for you, having now kind of been in the space and really diving in deep into it, how does, I kind of like this question, like, how does one lose their ass in this game? Right. So like, if you don't know what you're doing, what is the stuff that you're seeing that just terrifies you? Like, oh my gosh, guys are doing this or doing that.
Yep. I think there's a lot more in this space than you would think at first sight that will come up during due diligence. So when we talk about the risks, I can think of an example of a park we just explored. I won't get too specific on it, but there was an example to where we thought the park looked amazing. The initial cash on cash was great, and it was a pretty quality park. Aesthetically, it looked like it got a decent resident base. However, the park was in a flood zone. Now, not only was it in a flood zone, but you also had private septic. And during due diligence, we also dug a little bit deeper, and we realized that there was an E. coli scare a few years ago. So some of the septic had somehow gotten into the water system, and there was multiple instances of contamination. And we think that all sounds bad enough, but then we go and we find out that there's only about 6 out of, so I think it was over 50 total septics that were permitted. meaning that if those septics had to get replaced because of contamination reasons or because the flood destroys them, then at that point there was no permit to begin with, so we'd have to get re-permitted, and the state could easily just shut that down completely, and that could potentially turn your investment into zero. Right. So there's potential to have instances like that, especially if you're not doing your homework, to where an investment can go to zero. I think you can definitely do a lot to try to block against that, but
sure,
that's a big thing too. I think you really have to be paying attention to these. We have septic, very common to have septic. So you want to know a lot about septic and know what to look for in terms of the quality if you're taking over septic, and how to do routine maintenance. You have lagoons, you have wastewater treatment plants, you have well water, right? These are things that are less common. I guess coming from the apartment background, I can't help but compare it a bit. You don't deal with that quite as much, right? So you have different kind of infrastructure issues there, but these ones you want to be very familiar with because they can be extremely costly, and you want to make sure you're doing your proper homework. In addition to even just when it comes to the setbacks, I mean, there's a lot of these parks that are, maybe they've been grandfathered in, and you're fine replacing. But if you don't know the local regulations, you might have a park where again the home burns down, or is just no longer in livable condition, and you can't replace it. So now you have one less home each time that happens, right?
Right.
So there's a number of issues along those lines that can happen, and then naturally, you always have your risk of just delinquency. There's definitely some parks that you just have really rough resident bases in, and it's not park specific. You can have plenty of apartments that do the same thing, but that's always sort of a headache. Is that you have to deal with delinquency, you have to deal with trouble finding creditworthy residents if you're adopting, a rougher sort of resident base. Some are crime heavy, and you have. Let's think what else. Those are kind of the initial big ones that come to mind.
So it seems to me that when evaluating, so from a passive investor standpoint, part of the evaluation for a sponsor that's executing sort of the mobile home park strategy is really, you've got to look, unlike once again multifamily or many of the other sort of commercial real estate assets, is that it requires you got to have someone on the team or a group of people or whatever that are just communications strategists and just good at, rolling out communication because once again, if there's some meat on the bone, if there's some value to be added, everything we've covered, in this short period of time, which isn't everything, sort of points to the fact that if you're good at that and you can navigate and win the residents over, and even when it has, like you said, there's mobile home parks often have sort of that crime, and those are just things, and that's once again more often than not might be why you're getting it at a really good price, or so it's, if that's built in to the purchase price. But to turn that around, you've got to have great communication skills. And I think I've seen some of the things that you've talked about just following the industry of just, you land in these local newspapers and it's an uphill battle, man. Like,
Yep.
you don't want to end up there, but unlike the other asset classes, it just, like I said, I'm sure there's times when people go and buy some multifamily property where many of the residents don't even necessarily even notice that something happened.
Oh yeah.
Like they're like,
Yep.
Oh yeah, I guess that makes sense now in retrospect, but didn't necessarily, like if you're not paying attention, you might not even necessarily notice the difference.
I definitely would agree with that. I think communications and setting the proper expectations and just playing a really hands-on role in operations is crucial. I think it's only going to become more crucial, especially from the investor perspective as well. Right now with pricing, it's not quite as, we'll say, forgiving. It's still in my view can be somewhat forgiving, but it's not quite as forgiving as maybe it was a few years ago, right? So having the right operators in place, we do daily calls with each manager at each property every morning, right? Because we want to keep a really strong pulse on that. But sort of if you're a passive operator at a certain point, that's going to come back to bite you, especially with where prices are moving in today's. There's definitely, you always want to invest with some margin for safety, and there definitely is still margin for safety in a number of deals out there, but there's going to become less of it, right, as things tighten up a bit. So I think that's really important to just be aware of.
Yeah. Cool. Yeah. Well, it's good. It's an interesting asset class. I mean, frankly, for me, for other than, the ability to generate, great return and stuff, I think that it's good to see these sort of come back into favor. I think that, given the situation, many, especially for lots of baby boomers as they enter retirement age, some people just haven't prepared, right? So that shift from sort of being a pensioner to, having to save up, I think we're just going to see that. And there's been books written about it. And it's sort of this, the homelessness amongst that sort of age class is something that not enough people are talking about. Mm-hmm. But I view personally, and I know you kind of hit on the senior living thing, but once again, there's always going to be some, decent high percentage of people that occupy these, even if it's not, spec specifically for senior living, where it's just going to be your older retirees. Mm-hmm. Right. So I think that to have people come in and clean these up and, make them what I remember. And maybe it's just because I have such fond memories as a kid, having lived in a mobile home park myself. And, just knowing all the neighbors, and it really does have this community, it can become a community. And if mm-hmm. folks like you, are approaching it that way, and once again, with the communication skills and going in and improving these things and making it a better place to live, that improves community. So for as much as, most of us spend most of our time talking about how to make money in real estate, and, it's sort of, once again, and that's the name of the game. But it's nice to know that you can talk about improving communities and not just be some lip service. Mm-hmm. Right. And that's what I kind of like about it. But the guys who go in there and just think that they can jack rents and do whatever, I just think that, one, it doesn't work. Mm-hmm. Two, it's inhumane, and I don't know. It's just, there's a special place in hell for those types of people. So
yeah. Right. No, I agree. I think overall it's a very positive thing. I think all the investment that, and all the eyes that are moving towards this space should only improve. Will have a net positive impact on the quality of parks. I think having more professional screening systems is more likely to keep kind of crime and criminals out of certain parks, right? Making it a cleaner, kind of better place to grow up in. And I think just like anything else with professionals running it, I think you create a better place to live, and say that, it does cost more. I think people are willing to pay more for, mm-hmm. To be able to sleep better at night and be able to have, just an overall better quality home.
Most definitely. Cool. Well, thanks, Dylan. I appreciate your time. It's good having you on the show. Best of luck to you. And for the rest of you, check out, I've just published a new ebook here on sort of the Passive Investor's Guide to Sponsor Due Diligence and all things due diligence in real estate. So be sure to download that and check it out. We've got checklists and all those things that you can kind of run through to make sure that you're evaluating sort of those you're dealing with appropriately. Thanks again, everyone. Have a good day.